Hello, everyone, and welcome to today's webinar, Do You Know the Options for Deferring Capital Gains Taxes? Presented by Robert Binkley and David Fisher. My name is Amanda Jenkins, and I'll be your host. I work as the Education Manager here at the REALTORS Land Institute, and I'm excited to be a part of today's session. The REALTORS Land Institute, the voice of land, continually strives to maintain its status as the acknowledged leader for all matters pertaining to the land real estate profession. RLI endeavors to remain the essential membership organization for the extraordinary real estate professionals who broker, lease, sell, develop, and manage our most precious resource, the land. We're here to provide our members the expertise, networking, and valuable resources that are the foundation for all land real estate professionals. Today's webinar is going to help you gain a deeper understanding of a lesser-known tax tool that can help you close more deals, obtain more listings, defer taxes when your seller wants to sell and retire, and defer taxes regardless of the property type. Now today, during the presentation, we'd love to hear from you. You can type your questions in the chat box, and at the end of the session, Robert will answer them during our Q&A period. Now I'm pleased to introduce one of our speakers. David Fisher is the founder of the Creative Real Estate Strategies in Houston and has been a sponsor of REALTORS Land Institute for over 10 years and has sponsored over 40 events. He's been a sponsor at 7 national land conferences as well as chapter meetings and brokerages conferences all over the country. He's written a number of articles for RLI's Terra Firma publication, as well as a number of magazines specializing in ranches and farms and numerous broker websites. There is no truth to the rumor that David fought alongside John Wayne at the Alamo, but still claims he was the one that shot Liberty Valance. We are still waiting for Jimmy Stewart to confirm. Again, thank you for joining today's session, presented by David Fisher and Robert Binkley. David, I'll pass it on to you.
Thanks, Amanda. I appreciate that. And I would like to thank you and your staff for going way beyond the call of duty. The webinar turned out to be larger than anticipated, and Amanda and her staff has really been extremely helpful to us. Just a quick note or two. We have a real interesting group of brokers. We have brokers that specialize in land, ranches, and farms. We have brokers that specialize in commercial properties, and we also have brokers that specialize in residential properties. The interesting thing is the information that Robert is going to share with you in just a moment works for all types of real estate. So with that in mind, let's get started. As all of you know, Congress is considering ending 1031 exchanges. I hope they don't, but it could happen because, after all, they're Congress. So with that in mind, I think this is going to be a very timely webinar with some great information. So let's go ahead and get started. I'd like to introduce to you our main speaker, Robert Binkley. Robert is the CEO of the estate planning team, and he's also a member of the Forbes Wealth Council. If I told you everything else Robert has accomplished, there wouldn't be enough time for the webinar, so I'll let Robert add some things as we go along. One thing I can promise you is that if you can incorporate some of the information that you're going to hear today into your personal business, I will promise you that you can sell more real estate. So with that in mind, Robert, it's up to you now to do good on my promise, and I know you've got some great information that everyone's going to really enjoy. So Robert, the floor is yours.
Thank you, everyone. Thank you, David. Thank you, Amanda, for setting this up, and really appreciate the REALTORS Land Institute for granting us the opportunity to give you this information, because we think it's very educational and it's timely. So today, what you're going to learn is who is the estate planning team, a company that I formed 21 years ago, and why I formed it, because I think we want to help people like yourselves, professionals, and what is the Deferred Sales Trust, and how can the DSD really significantly reduce your tax liability when you sell an asset. So very important to note is we kind of look at the nation's wealth, the American's net worth, and this might be a number that goes up and goes down all the time as the markets go up and go down, but we're just going to kind of draw a line in the sand and make it $84.9 trillion of wealth, of which 14% is in private equity, 22% is in pensions, 24% is in stocks and publicly traded stocks, and then 35% is in real estate, which is a huge number. And so we really think that's an important number for what we do. Is nearly 50% of the nation's wealth is in private equity and real estate, which is a huge amount of assets that are illiquid, and transacting is now becoming very important as they get older with the baby boomers. So why did I form the estate planning team to deal with all this? Was really, I formed it so we could all join and be part of a team to organize and help the number one people that are in need, or the clients that own this real estate or business sales or things that have capital gains as their baby boomers. And we created this because we believe that there's a perfect storm. Now, 21 years ago, nobody wanted to hear about it. They just wanted to do, exchanges or keep the property, which was the right thing to do. But we did have people back then wanting to retire and utilized our structure. So we've been utilizing this structure for 21 years. We've had no issues with the U.S. government from a federal or a state issue. We've grown dramatically over this time because we're in this perfect storm. According to the American Bankers Association, $17 trillion of assets will pass from one generation to the next over the next 20 years. And so, there needs to be help, to give these people, especially baby boomers, a solution. And these baby boomers are starting to retire. They need the direction because interest rates are at an all-time low. They need as much money as they could possibly get. They need liquidity. They need diversification. There's 77 million baby boomers in the U.S. alone. And, every day about 10,000 baby boomers will turn 65. So imagine, I'm sure a lot of us are on this call that are baby boomers and are starting to kind of look at their situation personally, but not only personally, you're a business professional and you're probably looking at your clients and saying, geez, I know these clients want to retire. They don't want to pay tax up front to the government. They'd like to get liquidity. They'd like to have diversification, and this is their time, and maybe they don't want to own the farm, and their kids have gone off to college and they just decided they don't want to get up at the early hours and do farming anymore. They have other ideas and they don't want to come back. So they're on their own to kind of figure out what the retirement is and what to do with the farm. And yet they've got a lot of estate taxes and they've got a lot of capital gains taxes associated with that if they decide to sell. So they just keep farming. So is that a good solution for them? Probably not. But that's what they know, that's what they do, and ultimately, taxation is probably one of the biggest things that people look at as an obstacle when they decide to list it and go forward with a sale. The big thing about that is capital gains rates have increased. We've seen that. We've had the Obamacare tax, which is the 3.8 Medicare tax that's been added to people that make a large amount of money, and that gets added to the sale, which a lot of people don't know. And many state income taxes have increased as well. And sellers could face, if they've got their farm or land in a corporation such as a C corporation, they may face double taxation, corporate tax and personal tax, which is not exactly the best thing. And the U.S. has the highest corporate tax in the free world at 39.1, which obviously there's going to be some winners and some losers with this new tax reform act. But for the high-end earning wages, they'll get some relief. And overall, I think we'll see how that plays out. And as David mentioned, that our concern on 1031 exchange issues is that that's not been settled yet. We don't know how that's going to be settled, and there is some uncertainty at the QI level, which are the qualified exchange companies that handle 1031s. They're calling us for jobs, being prepared that in the event that something does happen drastic, that they're looking for a direction, and we think this has been the direction all along. We work with the Deferred Sales Trust because it's on solid ground. It's an installment sale. and it's been around. Installments have been around 84 years, so it's well versed in the code. It's just the code has never really used it in the way we use it, and we believe that the way we use it is really futuristic. It's opportunistic, and it's really a good idea for people. And it kind of ultimately, in my view, is if 1031 stays around, I think it would be a better choice. And here's why. We are in a very low interest rate environment, and some numbers came out today that may suggest we start to see interest rates hike up a little bit. So interest rates, again, are hovering at a 40-year low. That's, what happens to cap rates, as you all know, in the commercial real estate, or even in looking at investments. Those rates are so low because you're having to pay a premium because of real estate, and certainly the concern is a lot of people buy real estate and they actually go out and get loans to make the arbitrage on the rent rolls and things that they can make and borrow at lower rates. When that tightens up, people lose money, especially if they're buying today, unless they can raise their rents to keep up with that and increase the rent rolls. But unfortunately, a lot of those rent rolls are maxed out. People can't afford to pay what they're paying today. It's problematic, and if interest rates go up, that's when people start to lose money. So, a lot of people don't want to exchange. A lot of people want to get out. They ultimately would like to sell, but property owners, business owners are reluctant to sell because of capital gains tax, and that's what your client's got his arms crossed. He's not excited about selling. There's no real reason to sell because he doesn't want to pay the tax. He doesn't see a 1031 exchange in the horizon that makes any sense at all. Mom and Dad taught us to buy low, sell high, and buy low again. Mom and Dad did not teach us to buy low, sell high, and buy high again. That is kind of a common practice in buying real estate, but we're seeing some of the most sophisticated real estate people and business people want to get out, and they see this as kind of a timing to do that, and yet, they'd like to get some money on the sidelines and get more liquidity, and this becomes a really good source. So, owners of highly appreciated assets are reluctant to sell because of capital gains and depreciation recapture. So what really happens and what drives you as professionals in the industry, no matter what you do, if it's driven towards transactional business and taxes are an obstacle, usually option one typically falls into your roadblock. They don't want to sell. There is that option. The benefits of not selling, though, can be, the advantage is really just beneficiaries and inheriting a capital gain asset, a highly appreciated asset, may not pay tax because they could get an unlimited step-up upon death. So the advantage is you can tell your clients that they have to die to give the beneficiaries of their estate no capital gains, and that's not too exciting for them because they still are baby boomers and they still have a lot of time to retire. That's not exactly a good message. It is a message, but it's not the one they want to hear. Death and taxes. That's not the best words to say to a client. So there is that opportunity if they are getting really old, and that might make sense to wait around. But there is some talk about the unlimited step up pretending could go away. They would be best suited to hit that hard because there's a lot of money there that the government could really tap into. But again, that's all still up in the air. And right now, if you died today, family died today, husband and wife, then their children would get the unlimited step up on that. However, the disadvantages of that is, you could have an estate tax like a farm. You could get an unlimited step up, but then the estate tax triggers, and then you may not be in a liquid position to pay those estate taxes, don't have any life insurance. So a sale is needed to pay the estate tax, but the problem could be is that they waited till they died. That farm could be at a much lower valuation per acreage, and it could result in a discounted sale if the market turns down, and they could lose equity and the opportunity to sell today if those per acreage prices were much higher. So, we look at just time and where you are in the marketplace, and we think that you have to kind of study that and just decide for yourself if you want to keep the farm in the family. We could do that. If you want to eliminate the estate taxes on the farm and work with that, we can show you how to do that as well. If the son and the daughter as the beneficiaries, or however their beneficiaries make up, maybe 2 daughters, 3 daughters, 4 daughters, whatever that makeup is, we can get that asset over to the children without estate taxes. we also can, if there's no children, we can work to sell the farm and defer the capital gains and even remove the asset out of the taxable estate and give whoever they want, sister, brother, beneficiaries, if they never had children or charities, the option of being able to benefit. But back to the second option is the 1031. The fees are minimal. There is a consideration for what's going on right now, and I think that if anybody did anything with 1031, even though they just went forward, I think anything that they did, if they did take it away or change it, you'd be grandfathered up until that date. I truly believe that. I think everybody else does. The problem with 1031 now is there's rigorous rules. Clients have 45 days to ID. You got a total of 180 days, just two short deadlines that really, cause exchanges to fail and the taxes are due. And, there's a huge amount of percentages of those exchanges failing. The other real problem with exchange is you're not diversifying your investment into, you're going into one single asset or potentially a REIT type scenario, but you're all in one asset class called real estate. And, that's all, subject to interest rate risk and certainly default risk and all those things that, you could really look at. Clients have to replace their existing debt, which is not exactly what I think a lot of people want to do. They ultimately don't want to continue to debt is not your friend when markets go down. Debt can be your great friend when markets go up. So that's, one of the good things about debt. But, in an overvalued market, I think you have to kind of, reel things in a little bit and get a little bit more conservative in these markets for the people that have survived the 2008 crash, 2009. I think a lot of people could, they seem to forget all of that. And time has gone by, and they've made a lot of money because of all this extra money being printed and interest rates being so low. It has a euphoric feeling, and you just have to kind of remember what was happening back in 2008. For the ones that remember, they should have a lot of cash. And the other is possibly overexchanged market, overvalued market, and a lot of our larger clients that are very sophisticated that have a lot of industry experience are saying, and this is their barometer, call them analysts, experts, whatever. We use real life people that do it every day for many years are saying that they want out, they can't find anything, it makes no sense. I think most of you on this call are very sophisticated, understand that, and probably seem to agree with that. Yeah, there's always deals. You can catch people sleeping. There are situations where there's opportunistic. You guys can see a vision in some sort of a real estate where a lot of people can't. So that's really the makeup of real estate, the value of it. But what we are talking about today is the Deferred Sales Trust and what that can do for people's life to be a game changer. And I think the opportunity of time right now is really the time to kind of give everybody the idea of these options. And the advantage of that Deferred Sales Trust is just it's an installment sale. It's a very clean transaction, and people should learn about it and understand the basics of it, because I think it's a very important thing to understand. As either a tax practitioner, as a financial advisor, you need to give people that. And I don't think there's too much differences between a real estate professional, a business broker, or even a commercial real estate. We're all professionals. We all need to understand a very important fact is we deal with people's wealth. And no matter how we deal with it, you are a decision maker or somebody that gives information, and you need to provide, information that could be informative. And that's really why we bring this today, because, when I go back to the private equity, the wealth of this nation's in 50% of real estate. I mean, think about you as a real estate professional. You're managing or you're dealing with somebody's wealth, and you're dealing with in the opportunity to sell almost 50% of your entire net worth, which is pretty powerful in my book. I think that's a pretty substantial decision and dealing with people. So I just want to make sure that you understand you're really a big driving factor in helping people and giving them opportunities and ideas. So I want to make sure that you all give yourself a lot of credit for what you guys and gals do in this world, because it's very important to understand you guys have a meaningful part. The most thing is the advantage of the Deferred Sales Trust as an installment. It's going to give you the way to defer capital capital gains, cash out of real estate, or a business at the opportune time. You all know timing is everything in the markets. If you can get out at the right time, there's so many people that said I got out early before 2008, and a lot of people say, well, if you made a gain, you were lucky, and you're lucky you got out. So timing, sometimes you're ahead of the game, but then sometimes you're not. But it's better to be ahead than not. And the other thing I would like to say about the deferred sales trust is it gives you the ability to diversify your deferred sales trust note and earn interest on what portion of what would normally be paid to the IRS or the state that you live in. You're going to be able to live on more money, and that's really the two advantages of what I see in the installment process. Traditional installments, if you sold your farm to somebody and you carried paper, the problem with a traditional installment, I just look at it, and I was with a business brokerage group yesterday, a very large group, and they said, why wouldn't we just want to carry paper? And it was a really good question. And I said, well, let me just tell you that the main goal here is clients want to get away from their farm. They don't want to have to get it back at a later point in time. The other real thing is a lot of people don't want to cross-collateralize. If you sell the farm, they're not going to want to, give you other assets and say, well, I want the farm and I want your firstborn child and your grandchild or grandson to be, on the hook too. They're not going to do that, and you're not going to get that cross-collateralization unless that big farm company wants it so badly that needs it. You could probably ask for the moon. But what we see is a lot of people want to get cashed out, and money's so cheap right now that a lot of people that want to buy want to use the bank's money because they can arbitrage the difference in their earnings and not have to pay you the higher rate. So they're going to try to negotiate either doing some sort of an installment with you, or they may want to pay you off early because they can get cheaper loans somewhere else. So the early payoff and default risk are the two biggest things that we would say are really pretty common with traditional installments. So with us, the deferred sales trust is really a better way because we're not carrying paper on the asset that you sold, and we're not having the issue with early payoff. Even unless you want your money early, you can get it, and it's liquid. So, the other thing is you're not diversified. So if the farming market went dramatically down, you could, fall into a problem with, concentration issues with one property that you're carrying paper on. So we like to have liquidity and diversification, which is very important. The disadvantages or fees are often more than a 1031 exchange. And, the clients must sell to a third-party trustee and give up control and become a secured lender. So that's kind of the biggest thing that people don't understand is giving up control to a third-party trustee. We have trustees all across the country. They're all bonded. They're all insured. But more importantly, they're all very ethical. They're, usually tax attorneys or securities attorneys, or they're in big, large CPA firms that are our trustees. So they're very successful financially to be our trustee. But more importantly, you're not giving up technically control because you are the lender and you control your money from an agreement, and we hold all our money at some of the biggest banks in the world, one of them being Bank of New York Mellon, which holds $29.5 trillion. It's the largest clearing firm in the world. So that's who we use to hold money. So, that's one of the biggest things is what you get with us is the last option is just to sell and pay your tax. I mean, there is an advantage to just doing that, and you've got the freedom to take your money and do whatever you want to do with it. The problem is you're just going to have a lot less, and, depending on your income, and you could be facing higher capital gains, depreciation recapture, and, the net investment income tax of the Obamacare. There's no net tax benefit or investment from tax deferral of the capital gains if you just did that. And obviously there's a lot of freedom there, but we always look at people's situations. So let's kind of walk you through a sample case. John Smith has a $5 million sale. You can call it whatever kind of sale you want. The cost base on that is $1 million. You're looking at $4 million. I live in California, so I experience pretty high tax rates, and also New York does as well. So some of you are Midwest people. Those are the nice people of the world. I always say the Midwest people are the best people in the country. So for those Midwest people, keep it going. As far as the tax out here, state of California, 13.3, pretty substantial. If you were under $1 million, you're looking at 9.3, but you got the Medicare tax. I mean, you got federal 20. You're pretty substantial. So so the tax due on that is $1,484,000. That's not exactly the kind of check that anybody on this conference video would want to write a check, or any of your clients are not going to be too pleased with having to write that check, and that can throw a big red flag on your deal and trying to sell a $5 million. And some of you are dealing with much larger cases. We've got some business sales are $55 million. One of our cases was $125 million. So the thing that I would say to each and every one of you is just kind of analyze what the tax liability is for your client, and ask the client, can you write that check? And if they can and stomach it and they want to, then fine. But if they can't, this might be the option for you. And again, our goal is to teach you how this DST works, so this can be something that can be useful in your industry as another way out, is what we call our article. So the deferred sales trust, again, I'm going to continue to reiterate, is an installment. A lot of times when you talk to clients out there, or their CPAs are not going to say much about the DST, because when you say it's a deferred sales trust, they're going to say, I've never heard of it, it's a sham, lose my number. But if you tell them the deferred sales trust is an installment, their CPA is going to go, oh, I know installments. Yes, okay, great. So what is this deferred? You're going to get the call, you're going to get it set up so our tax people can speak with your client's accountant, attorney, representative, whoever that person is. And if you kind of look at these people, these are people that were selling a nice, expensive home, and they were originally with their arms crossed, and now they're really happy. If you can see their face, they're both smiling because they learned about the deferred sales trust. So it has that positive effect on people when they know that they've got a nice solution that could possibly give them liquidity and diversification, and give them all the different things that they were hoped that they could get when they go into retirement, or just if they want to get out and be able to offer that. So obviously this couple has beneficiaries, and they ultimately want to sell their highly appreciated real estate, and again, it can work for highly appreciated public or private stock. We can use the DST, and we have a DST and DST Plus, so we can use these for even trucking deals. We can use them for we do veterinarian sales, we do dental practices. I've sold a very rare Porsche into a gentleman in Germany for $2.5 million. So we've done that. We've done even farm and grain elevators. We've taken the actual inventory that somebody sells. We're doing a deal in Mexico where they're selling watermelons and grapes, where they sell it to the United States. We'll buy all their watermelons and grapes and give them back a note, and then sell those watermelons and grapes for the full value of that, and actually defer their ordinary income that they would have on their inventory. So there's some neat things that we could do for farmers that are looking to sell their inventory. Grain elevators, we have a lot of those deals. So a lot of those that you probably represent. We can do cattle, livestock, art, all those things that we can do. So whatever asset they want to sell, just run it by us, and we'll take a look and see if we can structure it for them. So the structure is really very simple. They have an asset, and rather than selling it to the cash buyer directly or taking constructive receipt of the cash when they sell it, it is very important for us to create this trust ahead of time, and we do that under a conditional agreement. Our tax law firm will actually create this agreement at no charge for the client. We'll do all the work and all the legal work at no charge, with the understanding that if they don't use the structure, even though we've done all the legal work and process everything to ready to close, and they decide that they want to exchange or pay their taxes, there would be no charge to the client, which is the right thing, and very rare for a law firm to do that. But we do that for the very purposes so we can get our work done and make sure from a tax point of view that this structure gets set up well ahead of the closing. And what that means is we need to actually create the purchase agreement between the trust and form the trust so that we can buy the asset from these clients under an installment. So what's really happening here is this trust, which is a Missouri business trust, and our law firm is out of Kansas City. and they have their law firm there, and they also have an accounting firm there. But we use that law firm as our main hub to create the trust. And we have other law firms all across the country that work with us, but we also have trustees across the country. But all roads lead back to Kansas City, and all cases get done in Kansas City. And in this case, the trustees all have the Campbell Law Firm, which is our tax law firm, in this case, buy the asset, from them through this installment process, which we call as the deferred sales trust. So step one is we create the trust, create a tax ID number. Step two is really the trust will actually negotiate with these clients to buy their asset. So in this case, it was $5 million. So the trust would be buying this asset for $5 million. Now, when I say buy it, it means we're buying it on paper. It does not mean we're deriving $5 million of cash and putting it in the trust and then wiring the $5 million to the client, because that would be a taxable event. What we are doing is having them sell to a third-party trustee in consideration of a secured installment note. And so what the trust gets is when it buys the asset from the client, it's buying it for $5 million, so the basis becomes $5 million in the trust. So this trust has got a zero basis, doesn't have any money in it. Ultimately, we'll put money up to buy and put some consideration into escrow and actually buy the asset from your client for $5 million and turn around and, in this case, resell that same asset that it just bought on paper, and it closes simultaneously. So as it's working to negotiate the price and getting everything set up the way you and your attorney and your CPA and everybody wants it, just the way you want it to make it perfect, it's going to create this trust, buy it from you, create this installment, and that installment could be interest only, it could be interest in principal, it could be a payback period over 5 years, 10 years, and it can go longer. It could go 20, 30 years. The goal is we don't do it any longer than 10 years, but then we can renew every 10 years with you. But my goal is to create this trust for your client to help you get the sale, because ultimately if they can see a way to sell it that can defer it and give liquidity and diversification, they're going to like that. So in this case, the trust buys it, creates a new basis, so that purchase price would be $5 million and the sale price would be $5 million from the client. Ultimately, the trust bought it for $5 million, and now it's going to sell it to the cash buyer. But ultimately, another agent that's either you double-ended the deal, or you brought another agent, or another agent came in and wanted to buy the farm and represents the buyer. So ultimately, that buyer is going to buy it from the trust. There's no issue that the trust ultimately buys it from the trust. And when you do a contract, a lot of times what we do is we tell the sellers, your client originally, before they sell to the trust, is to let the buyer know that the seller, which is these clients, would like to sell the asset and perhaps use a 1031, a charitable remainder trust, or a deferred sales trust, and that the buyer agrees, to those terms and they agree, but the costs are to the sellers. So you want to make sure that you disclose to the buyers ahead of time before the purchase contract gets drawn up. Or if the purchase contract is drawn up already, it's kind of down the road, can we actually insert the trust? The answer is yes, providing that they have not removed all their contingencies. If there's still contingencies between the cash buyer and the client themselves that are selling the farm or whatever asset, the trust can slide in the middle, providing that there's contingencies to be still agreed to. If both contingencies have been removed and the cash buyer is just getting ready to actually, send the money directly to the trust, then we would actually move you to an exchange if you qualified, and then we could actually do the deferred sales trust coming out of a 1031 exchange. So if any of you like to go that route, you want to try for an exchange and try to find something, we can actually go down the road directly to a 1031 exchange, and then, and ultimately fall out of the 1031 through a safe harbor provision as a defeasant into an installment from the 1031 exchange, so you can have your luck and try your luck at trying to do an exchange. But if the event the exchange doesn't work, you can ID nothing and just fall into in day 46 right into the deferred sales trust. Or if you've ID'd 3 properties and you have one of our exchange accommodators that have the defeasant languages built in that kind of parachute through the safe harbor into the trust, you can either do it in day 46, or if you've already ID'd but 3 properties or 2 properties, you'd have to wait till day 181 to be able to go through that parachute in through the safe harbor into the defeasant to the deferred sales trust. But let's assume that you have no ID and you have no any ability to do a 1031. If you've gone too far, we use what is called the binding commitment test. The binding commitment test is something that the charitable remainder trusts have used, and we want to make sure that that we don't have any issues with you've gone too far. We try to be as squeaky clean as possible. So it's very easy to get to clients before they've removed contingencies, or any of your clients that want to consider this. We train them, educate them, work with them so that they can understand it, and more importantly, look at this as an option for them, and that's really is something. But so the cash, ultimately, when the seller sells the asset to the trust has a new basis, so $5 million. Then the trust sells it for $5 million cash. It can sell it in carry paper if you so desire to allow the cash buyer to do a combination installment. You can do that, but most of the time the cash buyers want to use the cheap cash from SBA or things that they can get done, and there's no financing, so they'll just give you the cash. So the reason why it's not taxable to the trust, because the trust bought it for $5 million and sold it for $5 million, assuming that's the net of fee cost, and then now we invest this money inside this trust according to the note holder and what the note holders up there on the left would want. So this money is in $5 million cash. Let's assume there's no debt. I mean, the debt's not a problem either, because when we go to have the property sold, we sell it to an installment with the debt in place, and then we ultimately sell to the cash buyer, and the cash through escrow pays off the debt. So if there was $1 million debt, then ultimately there would be $4 million in the trust, which ultimately would be an installment back to the client. In this case, there was no debt, $5 million, and the clients are going to get $5 million paid back to them. And the investments inside this can be trust deeds, it can be cash investments such as laddered bonds, it can be all sorts of investments, ETFs, guaranteed annuities, anything that these clients feel and deem appropriate collateral is what they're going to get inside this. And what they're really going to get is a diversified liquid, diversified income that's going to be able to pay this last piece, which is the installment. Could be designed to be deferred for a number of years. It can be paid out interest only. It could be paid principal and interest. So just so you know, the advantages here, though, is that they will have the time value of money. And if you all know the rule of 72, how long does it take to double money? The IRS is not charging you on that $1,484,000 in tax. All of the $5 million is in there. So if you've got the IRS's money in the state that you live in, that money and the depreciation money all in this trust, and you're living on an interest-only component, you're paying your taxes. The interest income is derived to you through the installment note, but you're not paying any capital gains tax until you receive part or any part of your principal, and you would pay that pro rata. So if you had some basis, you'd get that back tax-free. You'd have pro rata tax on the capital gains and the depreciation number. You'd have to pay tax, and then in addition to that, you would have interest income that you would pay as another component of that installment if you did fully amortized. But if you just did interest only, you'd just be paying interest income, and all of that capital gains would still remain deferred. And again, the time value of money is that you have all the money that you would normally pay off to the government in the state that you live in, and that's all working for you without any interest that's being charged on that money. So just so you understand, there is some neat flexibility with all of that. So again, a lot of people want to maybe go back into real estate, and they'd like to go back in later on when market's correct. There is the mechanism that the trust can actually co-invest with you. This money is like a bank, but it's also a bank that needs to take care of you and pay you. It can make opportunistic opportunities that can benefit you through the trust for investments that can be made with you through an LLC outside of the trust, but the goal is to give you the flexibility, because most real estate professionals, want to be able to still continue to cycle that money back into things that can benefit the client, and we're all about, utilizing that money to be able to do things like that, providing that the trust would have an ownership interest in those investments, because there has to be business purpose for the trust to earn money and benefit the government. So every day, billions of dollars are transacted and not completed because of taxes. So, what we don't want to have is people, kind of telling you no because taxes, and we want to give them options. Pay the IRS or pay yourself is really the, our goal is to give you something that's 100% legal and to be able to work with something that's been around for a long time in the code. That's our main goal here, is to provide you and collaborate with your tax professionals, real estate professionals, business brokers, M&A professionals, tax attorneys that are all here side by side, working with you as a team approach. So, our whole team approach is really about you having those that team and together working as a team to really educate your clientele. Again, remember, your clientele leads you into their portfolio, but you also lead into the beneficiaries. Those become your next clientele as some of you are younger and you aren't retired and you want to start out with the older baby boomers that are getting ready to retire, and then at some point in time, death is imminent, but we don't know when that happens, and you'll eventually deal with the beneficiaries. We see this as a very valuable proposition for beneficiaries because it's just more money for them. If you can actually keep the client's monies going, through deferral, and that ultimately in the long run benefits them, and then ultimately they see you as a very bright, directed professional that they would probably want to work with because mom and dad worked with you. It makes a lot of sense to continue on that connection. So sometimes that becomes a very important factor. So at this time, because we only have an hour and I want to leave it to about 20 minutes of question and answer, I'd like to open this up for question and answers on this, and certainly we'd like to give you our toll-free number, which we will provide to everybody to get more in depth on a lot of this information so that you guys can drill down and we can kind of get to know each and every one of you and how your practice works, and to see how we can all collaborate on this educational process and see how this can actually maybe change the focus of the way you're marketing and directing your business to improve your sales, and that's really what we're all about. So I thank you, and I'll go ahead and turn this over to the moderator to read the questions off, and I'll go ahead and answer them as they come in. So thanks, everybody, and we'll keep moving forward with question and answer now.
Wonderful. Thank you so much, Robert, for such an informative session. Everyone,
you're welcome.
Yes, we're open to questions now. You can chat those into the chat box, and those will be read out loud for Robert to answer any additional information you're seeking after his presentation. So while you guys are asking, I'll go ahead and ask a question for either you, Robert, or for David. But what's a real-life example where the deferred sales trust would be an option for someone specifically working, with land clients, or where could this come in handy?
Well, we've had a lot of clients that obviously land is depending on where you're at, land can be with entitlements, and entitlements can bring a substantial amount of valuation to land as you buy it cheap and you entitle it. So when you bring those entitlements, the developer will come in and want to develop it, and obviously as you do that, we can take that land and buy it under an installment, and so we can sell it out to the developer when they want to when the entitlements are all in place. So that gives a huge jump in appreciation, so we can defer that. There's also a situation where a lot of land is used for renewable energy. A lot of that land is being used for other purposes that are good uses, and there's a lot of valuation increases because of that, and that's kind of more like a use of the property. But land can also be for farmers, and so farmers farm that land and they ultimately want to sell it. And so I had a grape grower. I live in California, but I had a grape grower sell it, all of his grapes, and he had no idea. He sold it for $7 million. And the person that bought it entitled it and turned around and flipped it for $14 million. So he had no idea that this client was not going to farm it. They just took all the grapes out and basically made beautiful homes on it. So everybody's got a different story, but like I say, I think we can kind of look at what their thought is on what the use of that land is, and if they think that value has gone way up and they want to sell it now, we certainly can defer it, if that makes sense.
Great. Yes. Wonderful. We had another question. Someone wants to know, what is the fee structure for the DST?
Great question, because we are not a nonprofit, so everybody kind of makes sure. But we are. We do a lot of institutional business, so we've structured our fees as all institution, no matter how large the client is. But so the answer to that is the trust is created with a conditional agreement, meaning that there's no charge until the transaction closes and until they decide that they want to use the transaction, even though we've done the work. Our tax law firm indemnifies for their work. It's very important that they understand that our tax law firm stands behind their work with audit defense if there was ever an audit. Now, again, we've done well over 2,000 trusts across the country through the Campbell Law Firm, and there's been 13 total audits, all no change. And in all of those audits, the Campbell Law Firm handled those and extinguished those at no cost to the client, as well as no liability to the client, and they continue to do that part of their agreement. Their fee, and we can send that to you too, so everybody just, if you don't remember it, we'll send you, if you want that, just to call us, we'll get you a copy of all the fees. But it's a one-time fee, anything under $1 million with a minimum of $5,000. So if you did a transaction very low, the minimum fee is $5,000, and we would look at typically a minimum case being like if they owe $100,000 of tax liability, could kind of be our minimum. But it's going to be 1.5% or a minimum of $5,000 of the sale price. Now, if there's debt, a lot of times they'll actually either do it as a gross sale or they'll do it as a net sale. So that's kind of, we leave that up to them depending on how much debt is on the property. So 1.5% up to the first $1 million, and then thereafter it's 1.25%. And as you go up, it can go lower. I've seen it, for deals that are $100 million plus, it can be, very low. So again, I leave that to them to negotiate. But the standard fee is for anything under $1 million is 1.5% one-time fee, which includes all the audit defense, and that really is 1.25% over the $1 million. And it gets paid from the close of escrow as an expense. The other expenses would be the trustee fee, which is an annual trustee fee, which is anything under $1 million is at 0.5%. Anything over $1 million, if you're $1.1 million, your whole entire fee from $1 all the way to $1.1 million would be 40 basis points. So just under 0.5% annually for the trustee to make payments, to do the things that you need them to do, and ultimately secure your money, to be making sure that the money is the way you want it to be invested as a creditor. So 0.5%, anything under $1 million, 40 basis points over, and if you start getting higher, it could go up, go down to 30 basis points. We've seen it down to 35, or actually I've seen it as low as 25 on a very large case, 25 basis points. The asset management fee is really just typically 0.5% all the way up to 1%, depending on the investments that we utilize. We try to go into no load. We try to go into things that are low fees, but yet high performance with very good companies that have been around. Some of our companies have been around since 1968. Some of them manage over $750 billion. They manage Mercedes-Benz pension. They manage companies like Coors Beer, Panasonic. These are some of the biggest pension managers in the world, and we trust our money to those companies because people that live on fixed incomes in retirement need very good quality conservative managers. So we utilize those big managers to do those kind of things for us, even good markets and sideways markets and bad markets, and they've done great work for us even through 2008. So very important to have really good, solid core managers that do good work for us. So that's the kind of stuff that we like to utilize and put our best foot forward when we're talking to note holders. So those are the fees that we're encountering. And that's really it, with the exception of there is a trust tax return, which is anywhere from $500 to $800 annually, and that's the end of the fees. And again, you as a creditor have to approve all of those fees because it's all about us disclosing those, but we disclose them ahead of time, and they don't change. They're just really what they are. So thanks. Great question, too.
Great. Another person had a question. It said, how do you deal with a due on sale clause on an outstanding mortgage when selling to the trust?
Great question. Well, we are not actually we're not actually taking ownership of title, and we do it all at the same time. So great question. Is that a lot of people would think that we buy the asset ahead and then there's a due on sale clause. You're absolutely right. We don't buy the asset until technically the actual cash buyer comes to the escrow at the same time, so we simultaneously close at the same time. So there would be a due on sale, but the cash buyer is paying it off the day that that cash buyer is prepared to write the check to the trust and pay off that loan, and we're ready to close all concurrently, if that makes sense to everybody.
Wonderful. Are there any other questions for Robert before we end today? So we can go ahead and type those in the chat box. Robert, do you have anything else you'd like to add?
No, I mean, I can say just a little bit. I really appreciate everybody's time today. I know everybody's got a busy schedule. I hope this has been meaningful as a good informative information piece that everybody would kind of want to look into. I can also give you lots of references of other professionals that have kind of, I'm interested in that, but now they're really actively involved in it because we think it's a very valuable addition to everybody's practice. So we encourage you to call us so we can give you that information, and you can provide. We'll actually email everyone our contact information and to get in touch with myself or our estate planning team office, so we can assign you to our teammates that will help you get educated and understand this, so we can get you all the information that so you can feel good about it. So since there's no more questions, and I really appreciate your time, thanks for setting this up. It's been a very good presentation, I think, and a good first one. So like I say, we'll try to do as much as we can for you, and just give us a call. And thank you for your time, everybody. Have a wonderful rest of the week, and thank you.
Great. Well, thank you so much, Robert, and thank you, David. As Robert said, you will be emailed the contact information for his company, as well as be sent a webinar evaluation that you asked to help fill out. This helps us improve our land use education program, and gives us ideas for future educational opportunities in the future. So thank you all for attending, and we appreciate you being here.
Thanks, everyone.
Thank you. Appreciate it.